All right, let's dive into something that's, well, absolutely crucial for your CMA exam. We're talking about the capital budget. I call this the part of the master budget where companies make their big bets. You know, those huge, high-stakes decisions that really shape their future.
So here's our game plan. We're going to start with what these big bets actually are, then see how they cause a ripple effect through everything else. We'll walk through the 4 main steps of any capital project, talk about the risk involved, and then I'll give you my best strategies for the exam. Sound good? Let's go. Okay, Section 1, planning for those big bets. So, what actually makes a purchase a capital purchase? It's super important to understand how this is totally different from the usual day-to-day spending.
It all comes down to one key difference, really. You've got your operational budget. That's the day-to-day grind, right? Buying raw materials, paying the rent. That's all about using the resources you already have. But the capital budget, that's for the big bets. It's not about using, it's about acquiring. Brand new, major resources. Things like a fleet of trucks or $1 million software system. See the difference?
Okay, so here's the official definition, and you're going to want to highlight this one in your notes. A capital expenditure, or CapEx for short, is any investment in an asset that's going to give you benefits for more than 1 year. I love this part of the definition. It's the bridge that connects your big, long-term company strategy to your actual on-the-ground annual profit plan. It's how you make the future happen.
All right, moving on to the ripple effect. Now listen up, because this is where I see so many students make a mistake. They think the capital budget is this standalone thing. No way. It sends out waves that touch almost every other part of the master budget. So, to really see this in action, let's take a super simple decision. Imagine the management team says, okay, we're buying a new, more efficient machine, and it's happening in July. Just that one sentence. Watch what happens next. It's pretty amazing. Okay, so the first domino to fall, the cash budget, of course. This is the most obvious one. In July, you're either going to see a huge chunk of cash just gone, right out the door to pay for it, or you'll see a big cash inflow from a new loan you took out to finance the purchase. Either way, the cash position changes big time. But it doesn't stop there. Next up, your manufacturing overhead budget gets hit. Suddenly, you've got a new expense on the books, depreciation. And remember, that's a non-cash expense. But here's the other side of it, and the exam loves to test this. Because the machine is more efficient, your utility costs might actually go down. So you have a new cost and a potential savings. And last but not least, the ripple hits the budgeted balance sheet. Your property, plant, and equipment, or PP&E line item, is going to go up. So think about that. That one decision to buy a machine has now directly changed the cash budget, the overhead budget, and the balance sheet. It's all connected. Okay, on to Section 3. I like to call this the 4-step dance. Because for the CMA exam, it's not enough to just know about buying the asset. You need to know the entire life cycle of the project, from the very first spark of an idea to looking back and seeing how it all went. So, step 1 is identification. This is just about finding good ideas for projects that actually fit with where the company wants to go. Step 2 is evaluation. This is the number crunching part, where you'll use all those fun tools like NPV and IRR to see if the project even makes financial sense. Then, step 3 is selection. You can't do everything, so you have to pick the best projects, especially if you're dealing with limited funds. That's called capital rationing, by the way. And finally, step 4, and this is a big one for the exam, is the post-audit. You go back after the project is done and compare what actually happened to what you thought would happen. It's all about learning from your wins and your mistakes.
So you might be wondering, why is this such a big deal? Why does the capital budget need to go all the way to the top for approval? Well, it all comes down to 2 really important words. Risk and irreversibility. Say them with me. These 2 words are everything. They are why these decisions are so high stakes. They're why the CEO is paying attention. Let's dig into what they really mean.
Look, if you make a small operational boo-boo, like ordering too much inventory, it's not the end of the world, right? You can have a sale or just use it up next quarter. It's fixable. But what if you spend $10 million building a super specialized factory, and the day it opens, the market for that product just collapses? What do? You're stuck. There's no undo button. That's irreversibility, and that's why this is so risky. You're locking the company into a path for 5, 10, maybe even 20 years. Okay, time for my favorite part. Let's talk strategy for test day. I want to give you a few key things that you absolutely need to remember when you're sitting in that exam. All right, my first tip for you, I want you to think of depreciation as the ghost of the asset.
the cash you spent to buy it, that's real. It hits your capital budget and the money physically leaves your bank account. But depreciation, that's a non-cash expense that sort of haunts your operational budget and your income statement for years to come. They are two separate things in two separate worlds. Do not get them mixed up on the exam. Tip number 2 is so simple, but it catches so many people. Check the timing. I promise you, the exam creators love to give you a question where an asset is bought in, say, July. If that happens, how many months of depreciation do you calculate for that first year? 6, not 12. It seems small, but getting that wrong can throw off your whole answer. Always check the dates. And my last tip is about the big picture. You have to remember the whole point of this. Why are we even doing a capital budget? Because it's what makes the sales budget possible. You can have the most ambitious sales goals in the world, but if you don't have the capacity, the right machines, the right factories, the right tech to actually make this stuff, then that sales budget is just a fantasy. The capital budget builds the foundation for success. So I'm going to leave you with one final thought to really test your understanding. This is a classic exam trap, so really think about it. How can one single purchase of an asset impact the cash budget and the budgeted balance sheet in such dramatically different ways? If you can walk through the answer to that, you're in fantastic shape for this topic. You're doing great. Keep digging in. All right, team, welcome back. We've already put in the work on the operational budgets, the plan for all of our core activities. So now it's time to tackle the other equally critical half of the master budget, the financial budgets. This is where we stop just planning what to do and start answering the single most important question in business. And this is it, right here. You see, an operational budget is your plan for profit. It looks great on paper. But the financial budget, that's your plan for survival. It really doesn't matter how amazing your sales forecast is or how efficient your production line is if you don't have the actual cash, the fuel, to make any of it happen. So let's break down exactly how we make sure that tank never, ever runs empty. So here's our game plan for today. We're going to start with the big picture difference between planning and reality. Then we'll dive deep into the cash budget, which is really the heart of this whole thing. After that, we'll talk about those big investments, see how it all comes together in the final financial statements, and then we'll wrap up with a clear, focused strategy to help you lock in those points on exam day. Okay, first up, plan versus reality. This is probably the most fundamental concept we need to get our heads around. It's all about shifting our mindset away from the activities we're planning to do to the actual real cash we have on hand to get them done. And this right here is the key distinction. On one side, you've got your operational budgets. They're all about planning our activities, what we're going to sell, what we're going to make. But on the other side, financial budgets are what ensure our survival. They focus on the money and, crucially, the timing of that money, turning our plans into the cold, hard cash flow we need to keep the lights on. So that brings us to the absolute star of the show, the cash budget. I'm not kidding when I say this is the heart of your financial plan. It's also a very, very high probability topic on the CMA exam, so you're going to want to give this your full attention. The cash budget follows a really clear, logical 4-step process. Step 1, cash receipts. And let me be clear, this isn't sales revenue. This is when the cash actually lands in your bank account. Step 2 is cash disbursements, which is when you actually pay your bills. Then, for Step 3, we just net those two out to see if we have a cash excess or a deficiency. And finally, Step 4, the financing section, tells us if we need to borrow money to stay above any minimum cash balance the company requires. Okay, now here's a pro tip that I guarantee will save you points on the exam. Please, listen closely. Depreciation is a non-cash expense. Yes, it absolutely shows up on the income statement, but it is never, ever in the cash budget. Why? It's simple. You don't write a check to Mr. Depreciation. No cash ever leaves the building. This is a classic exam trap, so please, don't fall for it. Now, the cash budget is perfect for managing all our day-to-day operational stuff. But what happens when we need to make those huge, long-term investments? Well, for that, we need a totally separate plan, the Capital Expenditures Budget, or CapEx for short. So, what is the CapEx budget exactly? It's our game plan for buying those major, long-term assets. We're talking about things like a brand new piece of machinery for the factory, a new office building, or a massive technology upgrade. These are typically large, one-off cash outflows that you have to plan for very, very carefully. And just think about the impact of something like this. Let's say we buy a new factory press for $500,000. Well, that entire $500,000 cash outflow hits our budget the moment we pay for it. Now, for accounting purposes, sure, we'll depreciate that cost over many years. But from a cash flow, from a survival standpoint, that cash is gone today. That's a huge distinction.
And at last, we've reached the grand finale, the budgeted balance sheet. This is where we finally close the loop and get to see how all of our careful planning, every single budget we've made, affects our company's overall financial position at the end of the period.
This is where you see that it's all one big, interconnected puzzle. Every budget we've built feeds directly into this final statement. Where does ending cash come from? The cash budget, of course. Ending inventory? We pull that from our production and materials budgets. Our new net property, plant, and equipment balance? That comes straight from the capital budget we just talked about. And our retained earnings gets updated from the budgeted income statement. See? It's all one cohesive system.
Okay, let's bring it all home and talk about what really matters, your exam day strategy. How do we turn all of this knowledge into actual points on the board?
Here's what you absolutely need to burn into your memory. First, always think liquidity. It's all about the cash. Second, remember that timing is everything. Never, ever confuse a sale with actual cash in the bank. Third, mind the minimum. In a problem, always be on the lookout for a required minimum cash balance. And finally, remember the big picture. This whole budget is a feedback loop. If your financial plan doesn't work out, you can't just ignore it. You have to go back and adjust your operational plan.
You've done great work getting through this. You really have. You now understand the structure, the logic, and the why behind the financial budgets. But we both know that the key to points on exam day often comes down to the mechanics. So the final question I'm going to leave you with is this. Can you nail the single most tested calculation in this area, the cash collection schedule? That's your next mission. Go practice that. Keep up the amazing work.